My strategy only gives me 1 to 2 trades a week, and honestly, sometimes it feels almost too simple, but it's the exact same one that made me over $35,000 in the past month. So by the end of this video, if you watch the whole thing, you're gonna have everything you need to read the charts and to trade market structure correctly. Because if you've been losing and it's due to not having a clear strategy, or maybe over trading, or because you've been letting emotions affect you, trust me, I get it. I used to be in that exact same position, and until I got something that got me results consistently, I was gonna be stuck there forever. But as I started to lock in on this strategy, everything started to change, and my new normal became profitable weeks after profitable weeks. So for that reason, today I'm gonna show you how to trade it in the best way possible, and trust me, you're not gonna wanna miss any second, because it might just be that last missing piece for you. All right, so first we're gonna find the right market to trade, because there's a lot of Forex pairs, and we want to filter out what is the best pair that we can possibly be trading. So as you see here on the right side, I have about 20 Forex pairs that this strategy works perfectly for each one of them. But as you also see, I have something called my watch list right here on the right side, and that's where I put the pairs that I'm most interested in for the week. So what you want to do is you only want to trade Forex pairs that have broken outside of consolidation and that are actually trending. So at the start of the week, you find those pairs that are trending and you add them to your watch list. So I recommend on the right side, just adding something called my watch list. And that's where your best pairs are going to be, because that way, instead of every single day throughout the week, let's say Tuesday, you wake up in the morning and you have to analyze literally 20 Forex pairs, it's going to become overwhelming and you're going to start to miss a lot of entries. But if you just have those 5 that you marked up and you analyze at the beginning of the week, and you know they have the highest chance of giving you a good entry, those are the ones you want to trade. So that way you only have to check those 5 or those 4. This is literally the most important part about everything, because I see so many traders trading the markets that are consolidating. Why would you trade the market that's ranging when we have all of these Forex pairs to choose from? We literally can choose from 20 pairs. So just pick the ones that are broken outside of consolidation. Once you've done that, we're gonna identify the key levels. So we want to find the price levels where price has been reacting off of the most, both on the 1 hour chart and on the 4 hour chart. You basically mark up the zone and you want to wait for a retest at that zone. So let's say, for example, we have an area and we see that the market has tapped into it multiple times, and every single time it touches it, it has a big rejection. That's going to be our key level. Now, obviously, I'm going to show you on the chart plenty of examples of this, but you're going to start to see how the 1 hour and the 4 hour chart, they align perfectly, and the key levels will work for both of them. All right, so after you've done that, honestly, the next step is to just mark up the market structure. This is way more important than you might think, and this is the whole essence of the strategy. Because in each higher high and each lower low, we're going to draw a circle, because we want to find out what phase we're on, at a higher high, a higher low, or somewhere in between. If we're somewhere in between, we don't want to take a trade because we don't have the highest risk to reward. We want to enter in at the higher low in a bullish trend to get the highest possible risk to reward and chance of winning. Now, once you have that down, once you have your market structure, you have the circles on every single low and high, we can move on to finding our entry. We're going to use the 1 hour moving average rejection as an entry confirmation, as well as we're going to use the engulfing candle rejection on the 1 hour time frame as well, and a rejection with a big wick. Will you have all 3 of these confirmations for each one of your trades? Probably not. But if you can get at least 2 out of these 3 confirmations in one trade, then that's a very high quality trade. And if you have all of them, then that's an A+ quality setup. So the moving average on the 1 hour time frame, we're going to be showing you how to use it and an example of it, but it's going to be the 50 EMA, and you basically just want to see price rejecting off of it. So let me see if I can show you an example here. So as you see right here, price used the 50 moving average. This is on the 4 hour time frame. It rejected it and it went down. Now for our actual trades, we'll be using it on the 1 hour time frame because it's just more relevant for our setups. But as you see, it also works out on the 4 hour. Once you have those confirmations, you need to have an exit strategy. So for me, I like placing my stop losses at least 10 pips below the higher high that I entered in off of. That gives me enough room to where even if the market makes a slight little wick below it, I'll still stay in the trade. And for the take profit, this one, you want to place it in the next 4-hour resistance. The reason why you want to place it at the next 4-hour resistance and not 1 hour is because that way you're going to get the next major structural point. And I found in my backtesting that this is a much better place to take out your profit. Now the trade needs to have at least a 1 to 2.4 risk to reward. From my backtesting once again, and from my live trading testing, I know for a fact that at least a 2.4 is optimal for this strategy. And if it doesn't have it, just don't enter the trade. The risk to reward needs to be good enough for you to take that trade. Now, once you have all of this cleared up, we can actually go onto the charts and show you real life examples of how I've used it and how even this week I've made profit using these rules. All right, so let's take a look at an example. So NZDJPY was a trade that I took this week. It actually was the only trade that I ended up taking this week. And that's one of the reasons why I like this strategy so much, because honestly, with just 1 or 2 trades a week, you can still be very profitable. Now, what is the first thing that I saw with this market? So let's start with the rules. Market structure. Market structure shows me that we had higher lows forming and higher highs. This basically means that the market was bullish and it was trending upwards. And just to show you how market structure looks, it consists of higher lows and higher highs. In each one of these higher lows, you're essentially forming an area of support, and in each of the highs, you're also forming an area of resistance. Now, basically, your goal is to predict where the market's going, consistently see that it's going higher and higher, and just wait for that higher low point to then enter your trade off of. It's really that simple. Now, what I did here was that I saw that we were making those higher highs and higher lows. So I was drawing the circles on each one of these highs. And basically that just shows me that it's a bullish market structure. But then we had something here where the market structure shifted, because this was a higher high, but this, instead of being a higher low, now it's actually a lower low. It is lower than this one. So that was the first sign that the market structure shifting. And then what really confirmed it for me was this lower high right here. So at this point, you went from making higher highs to the left to now in the future, now we're starting to make lower highs and lower lows. That basically tells me, okay, this market has shifted to the downside. So now we're gonna start to look for sells. Next thing are key levels. Right now I'm on the 1 hour time frame. And as you see, when I shift to the 4 hour, this area of support also looks very clean on the 4 hour time frame. So these key levels, they will align on the 1 hour and 4 hour time frame. Now let's go down into the 1 hour and let me clear this chart so you guys can see more clearly. All right, so now that we have this key level marked up in the markets, essentially, what are we waiting for? We're waiting for a breakout, because if we're going to stay inside of this consolidation, then we're not going to take a trade. That's one of our rules. We want to only trade the markets that have broken outside of consolidation. This one right here was consolidating for a while. As you see, it was consolidating for over a day. So no trades were taken in there. But the second that price started to break out, that's when I added this pair to my watch list. And that's when I was like, okay, I want to take sells on this with the bullish market structure shifting into a bearish market structure. Now, there is a pattern here that you may or may not see right now, and it's called a head and shoulders pattern. So literally what you do with this is you mark the left shoulder, then you mark the top, the head, and then you mark the right shoulder. What this does is it's a bearish pattern, and it shows you the market structure shift in just an easy to remember pattern. That's basically all it is. And as you see, it is a very powerful pattern. If I go into even the 2 hour time frame, it'll look a little bit more clean. And you really have to train your eyes to see these type of patterns, because at first, you may not see them. But the good thing is that you can always rely on market structure, just simply marking those higher highs and higher lows. Because if it shifts, you know immediately that it's starting to shift, because now instead of forming higher lows, and higher highs. Now you're forming lower lows and lower highs. So it's very, very easy to see the market structure shifting once you've just trained your eyes and just made it a habit to draw those lows and those highs. So once the market broke out of this area of support, it retested it into this key level. If you look closely, you'll see right now we're on the 2-hour time frame, but it also is relevant on the 1 hour. We came and we rejected off of this moving average up here, and here we got close to the moving average and we rejected it. So this is going to be the 50 exponential moving average. We want to use the 50 because it's the one that shows us the most clear trends. Once price comes into this key level, what's our next step? Because now we've retested it, we have a trend, we have that market structure, and basically we have everything in alignment. We start looking at the entry confirmations. So the exponential moving average is going to be the first one. But what do we do after we have the EMA? We want to see either an engulfing candlestick or a wick rejection. In this case right here on the 1 hour time frame, we had a big wick to the top showing us that the market was done going higher. It was not going to go any higher and the market was exhausted. The buyers had no more pressure and no more energy to keep going higher. So what we simply see here is that the wick on the top of this candle is significantly higher than the wick at the bottom. So we have more rejection to the top than to the bottom, and it's a bearish candle. From there, I ended up entering in on the next candle. And if you go down into the 30-minute time frame, you'll see why I entered where I entered. It was basically as this candle was about to close, I could tell that the market was going to close bearish. It had broken below the lows of these candlesticks and of those wicks. So essentially, okay, where's the market going to go? It's probably going to continue to go down. It's pretty simple. So I entered in with those two entry confirmations. We had the wick rejection and we had the EMA rejection. Remember, the EMA didn't really tap it on the 1 hour time frame, but it came close to it. And that's what matters. If you go up into the 2 hour, which is a hybrid between the 1 hour and the 4 hour, it can give you a pretty good idea of what's going to happen. Because in this case, it was more relevant to look at the 2 hour when it comes to that moving average. And even the head and shoulders pattern was a little bit more clear on the 2 hour time frame. So I would recommend that if it doesn't look too clear on the 1 hour or the 4 hour, you can take a look at the hybrid, which is the 2. If you see here, literally price rejected off of the EMA. We have a wick rejection candlestick. And do we have an engulfing candle? No, we don't. I took this trade without an engulfing candlestick. Now, the last step, super important. What's the exit strategy for this trade? Remember how I said that we're going to place our stop loss above the lower high in a bearish trend. And if we're buying, we're going to place it below the higher low. So it's very simple. Where is that price in this trade right here? Literally, it's right there. So you're going to want to place it at least 10 pips above the low or the high that you're trading off of. In this case, we got this lower high and our stop loss is just about 10 pips above that high. So it's very simple when you go about it that way because you're giving the market some room to breathe. And that's what gives your trade the highest chance of winning. And for my take profit zone, remember how I said that the 4 hour time frame is what we're going to use to mark those levels, those take profit levels. So in this case, I found this key level down here, this nice big area of support. And that's where I placed my take profit. It was right at 87.900. And as you see, the market actually tapped it right before reversing to the upside. And now we just got news, which made the market drop a lot. But that was some fundamental reasons. All in all, we saved ourselves by closing out right here at the bottom of the market. And how did I get that precise exit? All based off of the rules, because we're going to place our take profit at the 4 hour area of resistance if we're buying or support if we're selling. And how do you find those 4 hour areas of resistance? You just zoom out a bit. You see, okay, where's the market mostly rejecting? It's rejecting here a lot. It's rejected here many times. Look how many wicks we have right at that area. And yeah, I mean, you have all of those rejection wicks right there, along with some rejections here as well. So I just placed it at the bottom of this candlestick on the 4 hour time frame. And that's basically how I caught this entire move here on NZDJPY. And now I'm going to go ahead and show you another example. All right, so here we can take a look at another example on CADCHF. So if we take a look here, what do we have? The market, once again, has gone bullish. We have this low, and then the market came up and made highs. From here, we were essentially making higher highs and higher lows until the market pulled back into this key level. Now let's take a look at this key level and see why it's such an important area. Because if we go into the 4-hour time frame, we'll see that it's also an area of support and resistance on the 4-hour time frame. And if it's held on the 4-hour and on the 1-hour, those are the exact key levels that we want to be taking trades off of. It gives us the highest probability of winning. Now, what do we see here? First of all, I already see that the market has rejected off of the 4-hour moving average. That's a great sign to go bullish. If we go down into the 1-hour time frame, once again, the market also rejected off of the moving average, right around our entry, which is here. Now, yes, price did trade below that moving average for about a couple of candles, but if you notice, price rejected it and went right back up immediately after. So it's not really a big concern. If you're only looking at the 1-hour, this can almost seem like lower lows and lower highs, but you have to just zoom out sometimes and remember, that's probably just a pullback on a higher time frame. You're still in a bullish market. A good simple way to see that is, what's the size of the candles? Is the size of the bearish candles bigger than the size of the bullish candles? If it is, then maybe the selling pressure is higher than the buying pressure. But in this case, you can see that the buyers are still in control. This is just simply a pullback because every time the market comes down, it immediately gets bought back up. Every time it comes down, it leaves wicks to the downside, as you see right there. So the buyers are still in control. This is still a bullish market, and the exponential moving average, the 50 EMA, is still pointed upwards. It's still pointed straight up. So this is a bullish market that's pulling back into that 1-hour time frame key level. And off of that key level is where we're going to enter in. And that's where our entry confirmations come into play. What entry confirmation do you see here? There's an engulfing candlestick right here. This bullish candle is bigger than the previous bullish candle, and it's also bigger than the previous bearish candle as well. So that's a strong confirmation that that's where you want to enter in the buys. And another one of our rules was, is this a trending market? It's very clearly a trending market. We had some type of consolidation. The market broke to the downside at one point, and then it broke straight to the top side. So it's not in a consolidation, which is our first rule. We have our key levels. If we're going to circle our market structure, we're going to circle this low, this high, this low, and then our take profit is going to be our next higher high in the market structure. So we have that market structure. We have the EMA rejection on the 4-hour and on the 1-hour time frame. And as well, we also have our engulfing candlestick entry. Now, when it comes to our strategy for exiting the trade, remember what I said about our stop loss. Stop loss placement is very, very important. You find your low, in this case, our higher low, because we're buying. So every single time you're buying, your stop loss is going to go at least 10 pips below your higher low. And for us, that would be right around here, 19 pips stop loss. And for our take profit, the ideal situation is that we find a resistance on the 4-hour time frame. Now, if there is no resistance on the 4-hour time frame, you can just place it at your arbitrary 1 to 2.4 risk to reward. In this case, I think I found this area of resistance right here. But because the risk to reward wasn't quite a 2.4, you would have had to held a bit longer until you reach that 2.4. So in theory, this isn't the cleanest possible take profit level. The best possible take profit would have been right here for a nice 1 to 2. But like I said, one of the rules is to look for at least a 1 to 2.4 risk to reward. And if you follow all of these rules, your trade winning percentage is going to go up a lot higher. So for that reason, I'm going to go ahead and actually show you some of the results of this strategy, the win rates that you can expect, the risks to rewards that you can catch, and basically how to trade this strategy and how to actually track your data and see how often it works versus it doesn't work. All right, so let's take a look at some of the results from this strategy, because I feel like a lot of traders have some type of unrealistic expectations. And they also underestimate how much money that can be made by just taking a couple of trades per week. Literally, I took like 7 trades in an entire month. If you see here on the top right, these are the statistics from July 1st to August 1st. That's a whole month of trading right there. And we got a 62.5% win rate with a 1.7 risk to reward. Now you may be saying, why is the risk to reward not a 1 to 2.4 like you said in the rules? That's because some were closed out beforehand, and there was also some like break-even trades. Like right here, I think that was like somewhat of a break-even trade. There was a couple of break-evens that basically skews that risk to reward. But just imagine the risk to reward is actually closer to 2.4, and the win rate, instead of being 62.5%, it was just 50%. You can still be extremely profitable with taking 7 trades. You don't need to take 50 trades, and you also don't need to have a 70% win rate. You can have a 50% win rate with a 1 to 2.4 risk to reward and still be very, very profitable. Take a look at the profit factor. Profit factor being a 3 is actually pretty good. And at the end of the day, this was a summer month. It's not the best month. There's been better. And we still had our fair share of losses. But this is just what you can expect. And especially with the high quality trades that we're taking, you can literally just risk more money. So don't look at a strategy and say, oh, well, how many times does it play out? How many times does the strategy set up? Forget about that, because even if it only sets up once or twice a week, like right here, you can just risk more money on those trades. You can just put more risk behind the setups that have a high possibility of working. That's why I put over 5K on NZDJPY, and look how it played out, because at the end of the day, you're only taking 1 trade a week, 2 trades a week, sometimes 3, but they're all high quality. Imagine we're looking at 20 Forex pairs. We're picking 5 and we're trading 1. That's literally quality over quantity. Thankfully, I understood that pretty early on in my trading journey, because if not, I think I would have still been chasing those trades each and every day. Make your trading look more like this, where it's slow, controlled, taking a couple of trades, you're in and out. You're trying to let the market convince you to take a trade, not you're convincing yourself that the market has an opportunity. Because if you're trying to convince yourself that there's a trade, that means there is no trade. But if the market is showing you so many opportunities that are just so good to pass along, and you just hand pick the best one, your win rate is going to go through the moon. 50%, 60%, sometimes 70%, depends on your risk to reward. But if you follow this strategy, I'm telling you, your trading is going to become a whole lot better. For this to work completely, you need to have market structure locked down. So make sure to watch this video right here, and that's going to make everything just click a whole lot better. Make sure to drop a comment with what you want to see next, and I'm going to see you in the next video. Good luck applying this strategy and putting it to work.